Equity market right now is responding to the fact that the economy is showing signs of recovery. In fact, our base case is that the fourth quarter last year, 2024, seems to be the bottom in terms of the economic activities and in terms of the market sentiment. What we're seeing this year is both a gradual pickup in consumer spending and a little bit less drag, albeit still negative, from the declining property market. And the valuation, particularly at the beginning of the year, was pretty cheap. What you're seeing is now that investors are taking advantage of both cheap valuations and recovering earnings and coming back into the market. From our point of view, the market remains fairly attractively valued, especially compared to what's going on in the rest of the world, with certain developed markets valuations more stretched. So we're hopeful that economic recovery continues and brings with it the upward momentum in the equity market. In terms of some of the sectors that we find really interesting, and really ultimately it's the stocks that bottom up or company by company drivers. And so there are policies going on from the central government in terms of what's called anti-involution or regulatory intervention to prevent overcompetition in some of the sectors that are seeing overcapacity and therefore price wars or competition in a way that drives profit margin into negative territory. And some of these sectors, from aluminum to copper to some other manufactured commodities that have a setup that seems to be able to benefit from some of these regulatory interventions. They show signs of earnings recovery that are easier to forecast or to see from our point of view, and some of these stocks therefore look quite interesting to us. At the same time, there are always going to be a set of companies that are belonging to the more innovative part of the economy, whether these are technology companies that benefits from what's going on in continued AI investments, both in the US and in China, as well as some of the biotechnology companies. Those look very interesting for our point of view because of the more sustained long-term growth drivers that they're seeing. There's always a bit of change going on in policies and in the intensity of the rivalry between the two countries. What we are seeing right now actually is some of those in industry-specific sanctions, particularly on semiconductors, being rolled back. Interestingly, what we're seeing is China continues to push for domestic investments and domestic development in places like semiconductor. And that's unlikely, in our opinion, that's unlikely to stop or pause, even if there are temporary reprieves in some of these restrictions. Industry developments or ramped up investments that we saw as a response to sanctions and geopolitical rivalry that began as early on as 2018, in our opinion, in one form or another, probably will continue. And therefore, Chinese domestic push to reduce its reliance on some of these international suppliers and develop its own indigenous supply chain. We think that those efforts are probably going to continue for the long term. The Chinese companies, given the uncertainties going on, given the tariffs, their focus when it comes to exports have been shifting to other parts of emerging markets. In other words, a lot of the Chinese companies, when they think about expanding business overseas, setting up productions to serve overseas market, their first port of stop or destination is no longer the US. Today, the focus is places like Southeast Asia, places like Middle East, and places like Latin America. Now, we think that that's likely to be the case going forward for a substantial period of time. What we don't know is what's going to happen to the trend that we've seen in terms of shifting supply chains to friendlier countries or countries that are thought to be friendlier with the US, places like Vietnam, places like India, because those countries also saw a substantial rise in tariffs themselves in terms of their productions going to the US. And so I think in the very near term, in the absence of certainties, what's going on is a lot of companies are pausing their investment plans, right? Everyone is taking a wait and see attitude. And so I do think you're going to see lower activities in those areas for at least a number of years. I think for the first time in a long time that I can recall, earlier this year was the first time when there was a global market risk off and the US dollar failed to protect. And I think combined with what's going on in the US and what's going on in the forward-looking sentiment related to US dollar related assets, I think that's the reason why folks are looking outside of the US now in terms of diversifying their allocation away, right? And I think this is all part of what's going on with what we saw so far in very strong performances in places like Europe, in the emerging market overall. And I think China is one of the beneficiaries as investors hunt for returns elsewhere as they look to diversify away from their dollar assets. Part of the driver for the Chinese equity rally, particularly the global flow back to China, really isn't about China. It's about dollar assets. Then if the Federal Reserve reverses the current trend of fairly tight monetary condition in the U.S., that's probably one of the important catalysts of getting global investors overall to perhaps accelerate their allocation away from dollar assets into other international developed market or emerging market assets. And China is a beneficiary of that. But the capital flow in the short term, as you know, can't sustain without real fundamental support from the economy and from earnings overall. And as we discussed, there are signs that the Chinese economy has already bottomed and picking up. There are signs that Chinese corporate earnings have bottomed with the ROE picking up into 2025. And I think those real improvements in corporate earnings is going to be the most important driver to sustain the Chinese equity rally going forward.